Hello, I am your host Shravani and welcome back to our channel. As 2025 has come to an end, it's a time to step back and reflect upon this year. And to help us understand what 2025 taught us about investing, I'm joined by Mr. VishalDhawan, who's the founder and CEO of PlanAhead Wealth Advisors. Hi Vishal.
Hi, Shravani. Pleasure to be
So,
back.
yes, surely. So, we did see this year was full of surprises. Actually, we saw the market indices reach all-time highs, then lose their way. We saw commodities like gold and silver also reach all-time highs. Debt did well, and REITs also made a comeback. So, full of surprises. What do you want to say about that?
So I think this is quite normal. I think somehow there is an impression that markets behave in a straight line, and I think we see this with financial markets at all points in time, and it doesn't matter whether it's equities or real estate or gold or silver or debt. I think a lot of what happens in financial markets is that the script doesn't really get followed, and I think it's very important for us to be prepared for the fact that a lot of what we imagine the year ahead to be like and what will actually end up panning out to be can be very different from each other.
Sure, of course. So I guess my first question for you would be in terms of equities, what mistakes did investors make here for in terms of investing?
So I think it's important to sort of divide equities into two components. I think for a lot of Indian investors, they do have by default a lot of exposure to Indian equities, and Indian equities went through its period of moving up because when you ended 2024, there was a lot of positivity, strong momentum, and you did end up seeing that people were very, very excited about the fact that it looked like India might continue to grow at that same pace, and therefore their equity investments will also follow.
Okay.
In reality, what you saw is very quickly tariffs get imposed at the start of the year. You saw FI or FPI flows go out. You saw valuation concerns starting to emerge. You started to see earnings slow down. So you saw all of this starting to happen in Indian equities, and therefore you saw markets fall by about 12% from peak to bottom, then come back. So I think it's been a very tumultuous ride for Indian equity investors. In contrast, those who invested internationally, in spite of overvaluation concerns in many geographies, continue to see that markets went up. So I think when you look at equity investors overall, a lot of their experience last year depended on whether they were invested in just Indian equities or they had international equities by their side as well.
Of course, yeah, makes sense. So that was about equities. Vishal, we also saw how different market in different markets, asset classes, all asset classes as well performed well in this year at the same time. So what's your take on that?
So I think this is a very classic example of what I mean by things don't go by script, right? So classically what you would expect is if international equities go up, gold and silver will actually come down, and vice versa. You've had a year where you've had very good returns come through on precious metals, with some volatility of course, and you've had a very good year with international equities as well. In contrast, Indian equities have been relatively weaker. So I think the classical asset class diversification would have said that this correlation between precious metals and equities is going to be negative, and therefore build your portfolio accordingly. In reality, as you sit towards the end of the year, you can see that both of them have gone up together, and I think there are very strong reasons why that has happened, which can make people get very tempted to say that this is the new normal. In the future, equities and precious metals will go up together. I think the way we look at it is that what is less predictable is the exact timing on when these correlations go up together or go down together, or move in opposite directions. I think what you will normally see is that there will be, ultimately that correlation will play out. There may be certain periods where both these asset classes go up together, or they go down together. But in general, a precious metal as an asset class generally will go down when equities go up and vice versa. I think there's one more thing that's very, very important in this whole process is that the volatility on both equities and precious metals tends to be very high. And therefore the most ideal scenario that people think about is I would be able to time my exit from precious metals right, and then I will be able to time my entry into equities right, or vice versa. And historically, we've seen that that's very hard to do. Because what ends up happening is that whenever any asset class goes up, the narrative around that asset class becomes very positive. And therefore, it's very hard for you to sell because everything around you is telling you that it's going to go up.
Yes.
And or everyone around you is telling you it's going to go up. And the data may be showing something else. So I think for all investors, it's very important to reflect back saying that yes, even your asset allocation frameworks may need to undergo some tweaks because that also changes as time changes, but you do want to ensure that you don't get too carried away by the narrative. And we saw that happen with equity investors in 2024 in India, where valuations were excessive, but everyone believed that that market can keep going up more and more, especially with mid and small size companies.
Of course. Like you mentioned, we saw international equities as well as gold and silver all do well. So at such times, investors do question diversification. Why should one diversify? So what has 2025 taught us about diversification here, and why should one look into that way?
So I think at every point in time, in every year, if you go back in history, there will be one or two asset classes that will do well. And this year has been a great year, as we speak on international equities and gold and silver. But we need to remember that other asset classes have also done fairly well. If you look at real estate has actually gone up in value across many large cities in the country. So there's been a huge boost to infrastructure, connectivity, and in general, interest rates have also got lowered. So you've seen real estate prices also go up in terms of physical real estate. If you look at commercial real estate demand, it's been very strong. And therefore you've seen structures like real estate investment trusts actually see a very sharp up move as well during the year. You've seen debt actually gaining a little bit from interest rates coming down also. And therefore you've also had a good year for debt returns. And therefore fundamentally, if you sort of look at 2025, you'll find that besides Indian equities, most other asset classes have actually done quite well. And therefore, if your portfolio was well diversified, you probably had a fairly good year, in spite of the fact that the narrative around you and the noise around you would probably tell you that, oh, Indian equities have not done well and therefore it's not been a good year.
Yeah, right. Of course, also trying to address this part of information abundance that investors face in these times, especially with the onset of AI tools, etc. So, just wanted to know, does this information actually help investors in taking better decisions, or just ends up complicating things for them?
So I think 2025 is a great year because what it demonstrated is that those investors who managed their behavior well actually came out quite well through 2025 because they avoided making their portfolios fully tilted towards one specific asset class like Indian equities. They probably did not panic when markets started falling on the back of what happened with tariffs initially. They did not stop SIPs. They continued to invest. But I think those investors who did not manage their behavior well did not have a great year. And I think when you get a lot of information, the challenge that you face is very often you end up missing the entire big picture view that you need. Because if you ultimately are looking at your life on a year-on-year basis, you will find that life gets very hard because not all your events in life are going to happen every year. And therefore it's critical that you think through your own financial plan, think through what your retirement looks like, when do you require money, and then make choices and decisions accordingly. I think what has happened is AI is obviously taken over. It's very powerful. It helps with getting high quality data very quickly. But I think the information edge needs to get supported by a behavior edge as well. And what ends up happening is more often than not that information edge gets completely negated if you actually just make decisions on the basis of information. And therefore our sense is that you will find that over a period of time the combination of using that extra information coming at you quickly along with judgment and human intervention is probably going to be a great combination. And I think that's why the more we are able to see that happen, I think the more likely that investors will come out better.
Sure. I think next we'll look at how how global equities did well. So, like you mentioned, 2025 did show us that market leadership keeps rotating. So, we did see some underperformance in Indian equities and some sideways behavior as well. So, there were some opportunities that emerged elsewhere as well. So in light of that, how does global equities, how do they help during such underperformance?
So I think a couple of things are very important when you're thinking about investing. One is that there are always going to be new products that are hitting you. So you've seen, just this year about 190, close to 200 new offerings come through from mutual funds.
Sure.
You've seen, what are called specialized investment funds or SIFs get launched. You've seen the gift city starting to take its own shape, and there have been a lot of products that have got launched in that space as well. So I think as an investor, the opportunities for you to invest have also expanded substantially, and many of those opportunities that have got created now allow you to invest globally. And therefore, the advantage that you have as an investor today is that you can choose, if you want to look at various ways to build that international exposure. I think once upon a time, the impression that people carried was that you go international just because you want to diversify and lower risk, but your returns will always be higher in India. The data actually seems to show that there is no evidence that that diversification does not also help with potentially better returns in certain market environments.
Sure.
And that's what we've actually seen in 2025. And therefore our thought is that investors need to open up to start looking at many of these newer segments that have now come into the marketplace to see how they can use these to participate. So two big sort of opportunities continue to be that in our mind is that a lot of what you could do through LRS, which I think most families have used only for travel overseas or for sending money overseas for education, etc., will now start to expand much more to bring in international investments as well. Sure. And I think what investors need to be mindful of is they also do not swing to the other side, because what we see is when you have a very good year like 25 was for international investments, there is a tendency now to say, I want all my money to be international. And that could mean that in 2026, you could see a very different outcome. And then in 2026 end, when we're having this sort of a conversation, we're saying that, international equities underperformed. So I think diversification is going to be very, very important. Staying on top of the game in terms of what happens along the way and managing your own behavior. I think those are critical tools for investors to think about.
Sure. So now that we've established that the returns this year didn't just come from one basket or one theme, they did come from various asset classes or markets. So how does one look at liquidity in the light of all this? Should one look at liquidity in a planned manner or for their portfolio, or just like a leftover cash and use it whenever you want, or how does one schedule that?
Yeah, so we do think liquidity is definitely an asset. It's not just a convenience item.
Yeah.
I think what you need to do though is be very strategic about it and try not to create too much of liquidity. Okay. Because what ends up happening is very often we see that investors, when they start worrying about a particular asset class, want to move that entire component to cash and therefore liquidity. What we find is that working within certain well-defined ranges of, when some asset class is overpriced, to what extent will I reduce my exposure there, or vice versa when an asset class is undervalued, to what extent will I increase my exposure, works well because you then work within certain guardrails and certain risk management frameworks, rather than just trying to swing like a hedge fund between asset classes. Right. And we do see from data that hedge funds don't necessarily get these decisions right as well, and we do believe that investors will also not get this decision right, and therefore use cash strategically. But don't create too much cash in anticipation, because what can end up happening is that the cash drag on portfolios is a very real drag. And when you have interest rates which have come down,
Mhm.
that drag will tend to be higher, because when that cash is being held in your account, it's probably earning, as most investors know, interest rates in India now are such that a savings bank account rate of interest is 2.5% in most banks. So there is a meaningful cash drag that appears,
Yes.
and therefore use it well, use it strategically, but don't go overboard with cash.
Got it. I guess that brings me towards the end of this episode. So to just wrap things up, I think 2025 in terms of successful investing is not just about predictions but discipline and diversification. And markets, asset classes, or global opportunities, they will keep changing. But what's more important for an investor would be their behavior and their long-term goals, sticking to those. And yeah, so an investor who is adaptable, well informed, and well advised will is better positioned for the future in general. So thank you so much, Vishal, for this insightful conversation.
Thank you so much. I do hope everyone has a great 2026 year ahead.
Yes, thank you. Thank you so much to the viewers for tuning in as well. If you liked this episode, please consider subscribing to our YouTube channel. Thank you.
Disclaimers. Investments in securities market are subject to market risks. Read all the related documents carefully before investing. Registration granted by SEBI, membership of BUSL and certification from National Institute of Securities Markets, NISM, in no way guarantee performance of the intermediary or provide any assurance of returns to investors. The information is only for consumption by the client and such material should not be redistributed. The securities quoted are for illustration only and are not recommendatory. This material is for information and educational purposes only.